Welcome to the Deep Dive, where we unearth the fascinating stories behind the companies and trends shaping our world, giving you a shortcut to being truly well-informed. Today, we're plunging into a world you might not think about every day, but one that really keeps the entire global economy humming: B2B payments.
Yeah, it's massive. We're talking trillions of dollars moving between businesses every single year.
Trillions. It just dwarfs consumer transactions, doesn't it? I
Yep.
saw a projection, nearly $200 trillion by 2025.
Staggering numbers. And in that world, efficiency, speed, trust, they're everything. It's the financial plumbing, like you said, often unseen, but absolutely vital.
Exactly. And right in the middle of this intricate system, there's a company called Corpay Inc., ticker CPAY.
That's right, Corpay, a name that maybe isn't immediately familiar to everyone.
Probably not, and that's partly because they've been undergoing this, well, massive strategic transformation over several years, kind of quietly reshaping themselves.
Very quietly, but very deliberately.
So, our mission today is to pull back the curtain on Corpay. We're going to take a really comprehensive look. We'll cover the rebranding, their core business segments, their financial health, those big strategic moves.
And the risks and opportunities, too. Got to look at both sides.
Absolutely. The goal is to give you a clear, concise, and hopefully captivating understanding of this evolving player in the fintech space. We're going to unpack Corpay's story, dig into their business model, the competition.
And really ask, what does it all mean for their future, for their growth, their profitability?
And crucially, why it should matter to you. So let's get started. Okay, so this big strategic pivot, it wasn't just internal memos, right? It culminated in a very public moment.
It did indeed. March 2024.
That's when FleetCor Technologies, ticker FLT, which many might still recognize, officially became Corpay Inc., CPAY.
And you said it earlier, this wasn't just a marketing facelift. Not at all.
No, it felt much bigger than that. It was like the public declaration of this shift they'd been working on for years.
Exactly. The old name, FleetCor. It really tied them to their legacy, the slower-growing vehicle payment side. Fuel cards, basically.
That's what everyone thought of them as, right? The fuel card company.
For decades, yeah. But if you looked under the hood at the financials, corporate payments was this segment really firing on all cylinders.
Grow much faster.
Oh, yeah. Often 2-3 times the rate of the vehicle business. So the name change, it was a strategic necessity, aligning the brand with where the growth was actually coming from.
It's a powerful signal. I remember CEO Ron Clark being quite direct. He said something like,
The Corpay name better represents what we do now.
which is provide corporate payment solutions. Yeah, that's it.
Crystal clear. Tells you exactly where they see the future.
And it's a message to the market, isn't it? We're not just the fuel card guys anymore. We're shedding that legacy identity.
Embracing a new, higher growth future. But it's tough, for an established, successful company to redefine itself like that.
It takes real vision and probably some internal battles too, I'd imagine.
Absolutely. Rebranding isn't just logos and letterheads. It's about shifting culture, perception, investor understanding. Everything.
FleetCor sounded kind of niche, maybe a bit commoditized.
Right, whereas Corpay, it immediately sounds broader. Corporate payments? Fintech? A bigger pond?
It's a statement of intent. We're a comprehensive provider now.
And one phrase that keeps coming up when analysts talk about Corpay is this: disciplined, high-margin financial technology compounder.
Okay, let's unpack that. Compounder suggests reinvesting profits for growth, right?
Exactly. It means they're not just profitable, they're exceptionally efficient. And they consistently plow those earnings back into the business to fuel long-term growth. Disciplined growth.
High margin. We'll get into that later, but that speaks to efficiency and pricing power.
Definitely. And the financial technology part is key to this pivot. They're shifting from that mature, sort of macro-sensitive fleet business.
More exposed to fuel prices and economic cycles.
Right. Shifting towards a diversified B2B payments platform designed for much higher, more tech-driven growth.
So you've got this company with, rock-solid financials, great margins, actively pivoting towards faster growth areas. Sounds like the dream, but how often does that actually work?
That's the crucial question. What makes Corpay's attempt compelling is the foundation they're building on. It's not speculative. That corporate payment segment is already booming. We're talking high teens, organic revenue growth consistently.
So it's an existing engine, not something they're trying to build from scratch.
Precisely. And it's supported by that legacy vehicle payments business, which isn't dead money either. It's stable, provides cash, and is actually showing signs of picking up steam again.
Plus the cash flow. You mentioned that.
Huge financial firepower. They're projecting, what, around $1.5 billion in free cash flow for 2025?
That's a lot of dry powder for investment in M&A.
Absolutely.
Yeah.
And combine that with adjusted EBITDA margins consistently over 50%.
50%. That's
Yeah.
remarkable efficiency.
It shows real operational discipline and, frankly, pricing power from those proprietary networks and high switching costs we'll discuss. So it's a pivot, yeah, but one fueled by immense financial stability. It's an aha moment for investors, potentially.
Okay, that's the bull case, and it sounds compelling. High margins, strong cash flow, smart pivot.
Mm.
But, all right, let's put on the skeptic's hat. No transformation is easy. There have to be risks.
Oh, absolutely. We need a balanced picture. And there are definitely material risks and challenges facing Corpay.
Like what? What keeps management up at night?
Well, for one, there's the underperforming lodging payment segment. It's been dragging on growth.
Right, that's the smallest segment, providing rooms for airline crews, emergencies, that sort of thing.
Exactly. It's actually had negative organic growth recently. Management's been pretty open about it, even saying they're considering selling it off.
Divesting it. That brings its own uncertainty, doesn't it? Execution risk.
It does. Long term, it might be a right move for the portfolio, but short term, it adds complexity.
And then there's the macro picture. Always the macro picture.
Corpay is definitely exposed. Management talks about headwinds from FX rates, fuel price swings, interest rate changes. These things directly hit their guidance.
Especially with a big chunk of revenue coming from overseas.
43% outside the U.S., yeah. So a strong dollar hurts. And then there's their M&A strategy.
Growth by acquisition. They're good at it historically, but they've been doing some big deals lately.
Very big deals. The pending $2.2 billion acquisition of Alpha Group is huge. Combine that with Paymerang, GPS Capital Markets. It raises concerns about, well, M&A indigestion.
Taking on too much at once, spreading themselves too thin.
Potentially. Integrating large, complex businesses is hard. A misstep there could really slow things down, strain resources, delay those synergies they're counting on.
That could threaten the whole growth story.
It could. And don't forget the regulatory side. There's ongoing litigation with the U.S. Federal Trade Commission, the FTC, over some fee practices.
Right. That's been hanging over them for a while.
It has. Plus, the whole global payments landscape is complex and always changing. So yeah, these risks are real. Understanding them helps you see the full picture, the potential hurdles. So if you're watching Corpay, trying to see if this pivot is really working, what are the key things to track?
What are the vital signs?
Number one, organic revenue growth. Especially in corporate payments, can they sustain that high teens growth? That's the engine.
And also in vehicle payments, right? They're guiding for acceleration there.
Yes, particularly in the U.S. Hitting that 10% target in the second half would be a strong validation point.
Okay, growth numbers are paramount. What else?
Customer retention, it recently ticked up to 92.3%, which is great.
Wow.
Shows stickiness. But they need to maintain that, especially as they integrate new businesses and cross-sell.
Makes sense. Keep the existing customers happy while you bring in new ones.
Then there's the big M&A integration piece, Alpha Group specifically. Does it deliver that projected earnings boost over 50 cents per share in 2026? That's a major test of their acquisition playbook.
Huge validation if they hit that.
Absolutely. Also, watch progress on strategic partnerships, like the one with MasterCard for cross-border payments. That's key for global reach.
And finally, what happens with that lodging segment?
Right. Any strategic action there, a sale, a turnaround plan that will significantly impact the overall growth and margin story. So if you were tracking this company, these are the headlines, the metrics that really matter.
Okay, we've got the big picture, the strategy, the risks. But how does Corpay actually, make money? Let's peel back the layers on their operations.
Right. Let's get into the nuts and bolts. They organize things into three main business segments.
Serving, over 800,000 business clients globally? That's a lot of customers.
It is. And those segments are vehicle payments, corporate payments, and lodging payments. Each plays a distinct role.
Let's start with the biggest, the legacy business. Vehicle payments. Still nearly half the revenue, right? Around 47.7% in Q2 2025.
That's right. It's the bedrock. Think comprehensive solutions for managing anything vehicle-related for a business.
So the original fuel cards are in there?
Yep. But also EV charging solutions now, toll payments, parking, maintenance services. It's a whole fleet management ecosystem.
And you said it's mature, but not exactly dying on the vine.
Far from it. Performance has been improving. Organic revenue growth hit 9% in Q2 25. That's actually an acceleration.
And they're guiding higher?
Guiding for 10% in the second half, driven mainly by the U.S. business. So still finding ways to grow even in a mature market.
And who uses this? Small businesses, giant trucking companies?
All of the above,
Hmm.
from small businesses with just a few vans up to massive enterprise fleets, even government agencies. It's a very diverse customer base.
So for you, the listener, this is the foundation. Stable, improving, throwing off cash.
And providing a huge customer base they could potentially sell other services to. That cross-sell opportunity is key.
Okay, now for the star of the show, the growth engine. Corporate payments, around 35.6% of revenue in Q2 25, but that's where the real energy is.
This is the focus of the transformation. Absolutely. They offer sophisticated solutions to help businesses automate and manage their accounts payable, their AP processes.
And that AT automation market is huge, right? Still lots of manual processes out there.
Massive and growing fast. Lots of paper checks and invoices still floating around. Corpay's offerings here are pretty comprehensive.
Like what specifically?
Well, AP automation software to streamline invoices, payments, virtual card issuance for secure spending.
Virtual cards are getting big for B2B.
Huge. Plus, cross-border payment capabilities. They handle payments in over 200 countries. And currency risk management solutions, too.
So a full suite for managing payables globally. And the growth numbers here are impressive.
Very. 18% organic revenue growth in Q2 25. It was 20% for the full year 2024. Consistently strong.
And they expect this to become the biggest piece of the pie soon.
That's the plan. Management projects that'll surpass $2 billion in revenue and be over 40% of total revenue by 2026, driven by organic growth and acquisitions like Alpha Group.
So this is the future taking shape. Moving hard into digital payments, bigger markets, faster growth. That's what you need to see here. All right, then there's a third segment, lodging payments. Smallest piece, about 10.9% of revenue. What exactly do they do here?
They provide managed lodging programs. So think arranging hotel stays for mobile workforces.
Like airline crews between flights.
Exactly. Or stranded passengers during disruptions, maybe people displaced by emergencies like hurricanes or fires. It's a niche but important service.
Sounds useful, but you mentioned it's been struggling.
It has. It's the persistent underperformer in the portfolio. Revenue actually declined 2% year over year in Q2 25.
Ouch. Why the struggle?
Management points partly to cyclical factors, like a slower year for big weather emergencies that drive demand. But it's been a challenge for a while.
And this is the one they might sell off.
They've been very public about considering divestiture if growth doesn't return. It's a drag on overall performance.
So for you, this highlights a challenge, but also maybe management discipline, willingness to cut bait on underperformers.
Exactly. It shows they're focused on allocating resources to the best opportunities, even if it means shedding a business unit. Hashtag understanding Corpay's revenue generation. So across these three segments, how does the cash actually flow in? The revenue generation is pretty diverse, which helps explain those strong margins and stability.
Okay, break it down. What are the main buckets?
First, you have transaction fees. These can be structured in different ways: fixed fees per transaction, percentage-based fees, or sometimes a cost-plus markup. Depends on the service and the client.
So it's flexible, tailored to the transaction type. Makes sense. What else?
Interchange fees. These are earned from the bank that issues the card whenever a customer uses a Corpay commercial or virtual card.
And they issue a lot of cards.
They're the #1 B2B commercial MasterCard issuer in North America.
Huh.
That gives them huge scale and leverage on interchange.
Okay, fees, interchange. What about international stuff?
Foreign exchange spreads. When they handle cross-border payments, they earn a margin on the currency conversion.
A little slice on every FX transaction.
Yep. And then there's a category of other revenues. This includes things like late fees, finance charges if customers carry balances.
And that float thing you mentioned.
Exactly. Float. That's the interest income they earn on client funds they hold temporarily during the payment settlement process. Given the volume they process, that float can be substantial.
So it's a mix. Usage fees, card fees, FX, and then these other income streams like float and late fees. Pretty diversified. Hashtag the power of recurring revenue and high switching costs.
Now, here's a key point. Even though a lot of the revenue comes from individual transactions, the overall nature of Corpay's business results in a highly recurring revenue profile.
How so? If it's transaction-based.
Because their solutions get deeply embedded into their clients' daily workflows. Think about AP automation or fuel card management. These aren't occasional uses. They're integral to how a business operates financially every single day.
Right. Once you set up your fleet with their fuel cards and reporting or integrate their AP system with your accounting software.
You're not likely to rip it out easily. That's the key. High switching costs.
The hassle factor must be enormous. Retraining staff, reconfiguring systems, losing historical data. Ugh.
Precisely. It creates significant operational friction, customer inertia. Why switch if the current system works and is baked into everything you do?
Which explains those high retention rates you mentioned.
Exactly. Ticked up to 92.3% recently. That stickiness provides a really stable foundation, a predictable base of transaction volume, even if the revenue per transaction fluctuates a bit with the economy.
So for you, this means a solid business space. It's a powerful, almost invisible competitive advantage. Okay, let's zoom out again. We keep saying B2B payments is huge, but maybe we need to really hammer home the scale here.
It bears repeating. The estimates vary, but we're talking somewhere between, say, $98 trillion dollars and maybe up to $187 trillion dollars globally in 2025.
Trillion with a T. It's almost hard to comprehend numbers that big. It's not just a market, it's like a fundamental economic force.
It really is. And the crazy part is, a huge chunk of that is still handled manually. Paper checks, paper invoices, manual reconciliation. It's incredibly inefficient in many places.
Which means there's a massive opportunity for companies like Corpay, right? Just digitizing the existing flow.
Exactly. That inefficiency creates this enormous runway for growth. The market's projected to grow at a high single-digit, maybe even low double-digit compound annual rate for years, just by replacing those old paper-based methods.
So what are the big forces driving this shift? It's not just about getting rid of checks, is it?
No, it's driven by several powerful secular trends converging. Digitization and automation are huge. Businesses are desperate to cut costs, reduce errors, improve cash flow.
Makes sense. What else?
Embedded finance, putting payment tools right inside the software businesses already use. Think ERP systems, accounting platforms.
Seamless integration.
Yep. Then there's the demand for real-time payments, getting money moving faster. And globalization, businesses operating across borders need better, cheaper ways to handle international payments and FX.
So for you, this is a massive industry undergoing a profound digital transformation. Huge tailwinds for companies offering the right solutions.
Now, navigating this supercycle isn't easy. Corpay faces a really distinct set of competitors in each of its main segments. It's not one monolithic battlefield.
Okay, different competitors for vehicle payments versus corporate payments.
Definitely. They're up against a mix of established giants, specialized niche players, and those fast-moving fintech disruptors.
So let's break it down. Who are they bumping heads with in vehicle payments, the legacy business?
It's largely a duopoly situation there, mainly competing with WEX Inc.
Right, WEX. They're the other big name in fleet cards.
They are. WEX generally have broader network acceptance, maybe 95% of U.S. fuel stations. Corpay competes effectively by offering attractive discounts and rebates within its own substantial network, around 60,000 locations.
So WEX has reach. Corpay competes on price within its network.
That's a reasonable simplification, yes.
Yeah.
And you also have global players like Edenred, particularly strong in Europe and Latin America in mobility payments.
Okay, now shift to corporate payments. That high growth area, I bet that's a much more crowded field.
Oh, incredibly fragmented and competitive. You've got dedicated AP automation platforms like Bill.com, Coupa.
Big names in that space.
Yep. Then you have modules from giant enterprise software players like SAP Concur. Plus, modern fintechs like Stripe and Square are pushing hard into B2B now.
And the cross-border specialists.
Right. Companies like Wise, Payoneer, it's a real mix. This shows you the intensity of the competition. Corpay needs to constantly innovate, acquire, and differentiate to win here.
So in such a tough, fragmented market, just having good products isn't enough. You need defenses, right? An economic moat, as Buffett calls it. What protects Corpay's business?
Corpay has built several layers to its moat. First, those proprietary payment networks we mentioned. They operate over 15 of them, especially in fuel and lodging.
How does having their own network help?
It gives them much greater control over transaction data and pricing compared to just using open-loop networks like Visa or MasterCard for everything. This allows for potentially higher margins and, importantly, better fraud prevention. They see the whole transaction flow.
Okay, proprietary networks, that's one layer. What else?
Those high customer switching costs we talked about earlier, that's a huge barrier.
Because their systems are so deeply embedded in how clients operate.
Exactly. Ripping out Corpay's AP automation or fleet management system is a major, costly disruption. Retraining, system integrations, potential data loss, it creates powerful inertia. Customers tend to stay put.
So sticky customers, that's moat layer number 2. Anything else?
Scale and data advantages. Processing over $400 billion annually for 800,000 plus clients gives them enormous leverage.
How does that leverage manifest?
They can negotiate better terms with merchants, like getting those fuel rebates they pass on. And they accumulate this vast trove of proprietary data on corporate spending.
And that data is valuable.
Incredibly. They use it to refine their products, improve their risk management algorithms, spot cross-selling opportunities. It's a virtuous cycle fueled by scale. Hashtag the unified platform value proposition.
Now, here's an interesting angle on their competitive edge. This idea of a unified platform, offering an integrated suite of services, not just point solutions.
Yes, this is increasingly important. While some competitors might boast a best-in-class solution for just one thing, maybe just AP automation or just cross-border FX.
Corpay tries to bundle it all together.
Right. And the insight is that many mid-market CFOs are actually overwhelmed by managing dozens of different software vendors and integrations. It's complex and costly.
The too many apps problem.
Exactly. So Corpay's pitch is, we offer a single platform that's good enough, or often better than good enough, across a whole range of your payment needs. It simplifies things dramatically for the client.
Convenience as a differentiator, one throat to choke, so to speak.
Precisely. It reduces complexity. You have one relationship, one integration point, ideally. This bundled approach creates a really sticky ecosystem that's hard for those single-point competitors to break into.
And it must make cross-selling easier too, right? Once they're using you for fuel, maybe try the AP automation.
That's the goal. We've seen them having success selling AP solutions into that legacy fleet customer base. It proves the concept. So for you, the takeaway is that integration and convenience can be powerful competitive weapons, especially for businesses looking to streamline. All right, let's dive into the numbers. Looking back over the last 5 years or so, Corpay's financials tell a really consistent story.
Which is?
Resilient growth, very high profitability, and just exceptional cash flow generation. They've navigated some choppy waters economically, but kept performing strongly.
Okay, let's walk through that. How did revenue hold up, especially with the pandemic weirdness in 2020 and the recovery?
Well, 2020 was unique. They saw a nearly 10% revenue decline then, but they bounced back hard. Revenue grew 18.6% in 2021, then almost 21% in 2022. Really strong recovery.
And since then, growth moderated a bit.
Yeah, moderated to 9.7% in 2023 and 5.8% in 2024. More normalized, but still healthy growth, showing that resilience even as the macro environment got tougher.
Got it. Now, profitability. You mentioned high margins earlier. How high are we talking and how consistent has that been?
Consistently exceptional, really. Gross profit margins have hovered stably in the 78 to 8% range for the last 5 years.
Wow, 80% gross margin. That implies serious pricing power or cost advantages.
Likely. Operating margins are also very robust, typically between 42% and 44%. Shows tight cost control even as they grow.
And that flows down to the bottom line.
It does. Net profit margins generally range from 25% to 30%. Again, very strong. Net income grew steadily from around $704 million in 2020 to over $1 billion in 2024.
So the numbers really back up the story. For you, this shows consistent financial strength, efficiency, and a durable business model. Okay, the profitability is impressive, but what really jumps out at me whenever I look at Corpay is the cash flow. They just seem to gush free cash flow, FCF.
They absolutely do. Prolific is the right word. And that strong FCF is the engine, the firepower, driving their whole strategy.
Because it funds the M&A and buybacks.
Exactly. It's the cornerstone of their capital allocation. They generated, what, $1.77 billion in FCF in 2024, $1.95 billion in 2023. These are huge numbers, giving them immense flexibility.
And that FCF margin-free cash flow as a percentage of revenue is often over 40%. That seems incredibly high.
It is remarkably high.
Yeah.
And it's indicative of a very capital-light business model.
Meaning they don't need to spend tons on factories or physical assets to grow?
Precisely. Unlike manufacturing or heavy industry, their growth isn't tied to massive capital expenditures. This allows them to convert a huge chunk of their earnings directly into deployable cash.
Which then fuels that self-funding flywheel for M&A and buybacks you mentioned.
That's the beauty of it. It's a powerful characteristic of successful, scalable fintech models. Hashtag return on invested capital, ROIC.
Let's talk about another efficiency metric. Return on invested capital, ROIC. Corpay's has been consistently in double digits, improving from around 9.5% in 2020 to 12.6% in 2023. What does that tell us?
ROIC is a crucial measure, especially for a company that grows heavily through acquisitions like Corpay does.
Why, especially for acquirers?
Because acquisitions add goodwill, a non-earning asset, to the balance sheet, which mathematically pushes down the invested capital part of the ROIC calculation. So maintaining double-digit ROIC despite lots of M&A is actually quite impressive.
So it means the deals they're doing are generating good returns, enough to overcome that goodwill effect?
Exactly. It indicates that management is creating real economic value through its investments. They're buying businesses that generate returns above their cost of capital.
They're not just empire building, they're making smart, value-creating investments.
That's what the ROIC suggests. For you, this metric shows how efficiently Corpay is using its capital, both organic and acquired, to generate returns. It's a sign of disciplined capital allocation. Now, looking at the balance sheet itself, Corpay does maintain leverage. They carry debt. But it's important to see this as a strategic choice.
Not a sign of weakness, but part of the plan.
Correct. They use debt strategically to optimize their capital structure, fund that M&A strategy, and support share repurchases. It's a tool to enhance returns, managed within specific targets.
Okay, so how much leverage are we talking, and are they sticking to those targets?
Their leverage ratio, typically net debt to EBITDA, was 2.75x at the end of 2024. By Q2 2025, it had actually fallen to 2.53x. That's well within management's publicly stated target range, usually somewhere between 2.5x and 3.0x.
So they're using debt but keeping it controlled. How does working capital play into this? You mentioned float earlier.
Right, managing working capital is crucial, especially that float. Holding client funds temporarily between receipt and payment generates significant interest income, given their scale. It's a key part of their financial management.
So they're sophisticated users of the balance sheet. For you, this shows a company strategically using debt while carefully managing working capital complexities to fuel growth. Okay, let's shift focus to the recent past, say 2022 through 2024. That was a pretty wild ride economically for everyone. How did those big macro shifts, inflation, rising rates, recession fears, impact Corpay during this key transformation period?
Yeah, that period definitely threw some curveballs. The significant macroeconomic volatility had very real, tangible impacts on Corpay's results and outlook.
Like the rising interest rates, that must have hit their borrowing costs.
It did. Since they use floating rate debt, rising rates directly increased their interest expense. Management frequently called this out as a headwind. They used swaps to mitigate some of it, but it still had an impact on net income.
And what about recession fears? Did that dampen transaction volumes?
Management noted that corporate spending held up surprisingly well, but they acknowledged that a full-blown recession would definitely hurt transaction volumes across the board. It's a cyclical sensitivity they have.
Plus the strong dollar effect you mentioned earlier.
Yes, with 43% of revenue coming from outside the U.S., a stronger dollar meant those international earnings translated back into fewer dollars on the income statement. FX rates became a key variable they had to forecast and manage against in their guidance.
So it really illustrates how these big global economic tides directly affect a company like Corpay, something you always need to factor in.
And digging into a specific sensitivity, particularly for that large vehicle payment segment, is fuel price volatility. It affects them in more ways than you might first think.
Right. It's not just about whether high prices reduce driving. How else does it impact their financials?
Well, some of their fees are percentage-based, so the absolute price of fuel directly impacts that revenue line. Higher prices, higher fees, and vice versa.
Okay, that makes sense.
Also, the absolute price level can affect things like late fees and finance charges as customer balances fluctuate with fuel costs. But there's another piece, fuel price spreads.
Spreads? What's that?
It's essentially the margin Corpay makes between the price they charge the customer at the pump, often based on posted prices, and the lower wholesale costs they actually pay for the fuel.
Ah, so they capture that difference.
Exactly. But that spread can get compressed, especially during periods when fuel prices aren't moving much low volatility. In Q1 2025, they specifically called out a $6 million negative impact to revenue just from those spreads being squeezed by low volatility.
Wow. So it's quite nuanced. A good example for you of how specific industry factors can really matter. Now, during the same volatile period, Corpay wasn't just reacting. They were incredibly active reshaping their own portfolio, weren't they? Lots of M&A, but also selling things off.
Extremely active. It really demonstrates that disciplined capital reallocation we talked about and that clear focus on pivoting towards corporate payments.
How much capital did they deploy?
In 2024 alone, over $2.5 billion. Huge amount. That included buying Paymerang for AP automation, GPS capital markets to boost cross-border capabilities.
And those Brazil deals, too.
Right. Zapay and Gringo in Brazil focused on vehicle compliance. So, targeted buys, even within the vehicle segment, all aimed at scaling up key areas.
But they were also pruning the portfolio at the same time.
Exactly. That shows the discipline. They sold their Russia business in 2023, obviously related to geopolitical events. And in late 2024, they divested their comm data merchant POS solutions business.
Why sell that?
Part of a stated strategic review to simplify the company, shed assets that weren't core to the future vision, and really focus resources on those high-growth corporate payments and strategic vehicle payments areas.
So for you, this signals a management team making tough choices, actively shaping the company's future, not just letting it drift.
And alongside the M&A, a critical piece of the puzzle was continued investment in technology. In the payment space, if you're standing still technologically, you're falling behind. Fast.
Absolutely. What were some key tech initiatives during this time?
A big one was launching Corpay Complete. This is their integrated spend management platform.
Trying to bring everything together.
Exactly. It combines corporate cards, expense management, AP automation, all into a single interface, mobile ready. It's a big step towards that unified platform value proposition, making it stickier and enabling cross-selling.
And what about the EV transition? That's huge for the vehicle payment side.
They've been making significant strides there, expanding their EV charging network acceptance, now over 700,000 charge points globally, and launching specific solutions like the ChargePass MasterCard.
So one card for both fuel and EV charging.
Precisely. Supporting fleets as they transition. This shows you they're not just managing the present, they're investing actively to meet future market needs and stay ahead of the curve.
Okay, so looking ahead now, they've reshaped the portfolio, navigated the macro stuff. How do they plan to keep growing organically from here, using the assets they already have?
A huge priority is cross-selling. Taking those corporate payment solutions, AP automation, cross-border, and selling them into that massive existing base of vehicle payments clients.
Leveraging those established relationships makes perfect sense. Is it working?
They say they're seeing early success. Legacy fleet customers starting to adopt the full suite of AP services. It shows the synergy is real.
And they're putting structure around that effort.
Yes, unifying the U.S. sales force under one leader was a key move to drive that cross-selling more systematically.
Yeah.
And that Corpay Complete platform also makes it an easier sell, one integrated solution.
Okay, cross-selling is big. What else for organic growth?
New product development is key. Continuing to invest in those EV transition solutions is vital for the vehicle segment, expanding the charging network, refining the payment tools, and interestingly, they've unveiled a digital currency strategy, partnering with Circle to use stablecoins for payments.
Stablecoins. Wow, that's pretty cutting edge for B2B payments. Where would that apply?
Could be really powerful for cross-border transactions, potentially faster and cheaper, especially for larger enterprises. It's early days, but shows they're exploring next-gen tech.
Definitely forward-looking. What about expanding geographically?
Yeah, international expansion for corporate payments is another lever. They launched their payables product in the UK with plans for other regions. And that strategic partnership with MasterCard is crucial here.
How so?
It gives them a massive global distribution channel. They can offer Corpay's cross-border solutions to MasterCard's huge network of banks worldwide. It's a powerful enabler for international growth.
So multiple organic levers, cross-selling, new products like EV and digital currency, and international expansion via partnerships. Those are the concrete steps you can watch.
But let's be clear, organic growth is only part of the story.
Yeah.
M&A isn't just a tactic for Corpay. It's core to their DNA, their growth algorithm.
It's how they've built the company, largely.
Exactly. And the strategy here has evolved. The focus now is explicitly on fewer, bigger businesses. They want scale, particularly in corporate payments, to really accelerate that strategic shift.
So they're using M&A not just to add revenue, but to fundamentally change the shape and focus of the company quickly.
Precisely. It's about achieving critical mass and market leadership in those target areas. Corporate payables, cross-border payments. Recent deals prove it.
Paymerang, GPS Capital Markets.
And especially the pending $2.2 billion deal for Alpha Group. That's a huge bet, specifically designed to turbocharge the corporate payment segment and get it over that 40% total revenue mark by 2026.
It's an aggressive way to transform using that massive free cash flow we talked about.
Right, that FCF creates the self-funding flywheel. Operational success generates cash for deals, which generate more cash flow.
But the M&A indigestion risk we flagged earlier.
Exactly. That's the flip side. The sheer pace and scale of these recent impending deals introduce significant execution risk. Integrating multiple large, complex platforms simultaneously is incredibly difficult.
It could strain management, divert focus, delay the expected benefits.
All of the above. It could potentially disrupt the very flywheel that powers their growth. So for you, the M&A offers exciting potential for rapid transformation, but it also presents a massive execution challenge. Success hinges on flawless integration.
Okay, let's talk about how Corpay actually uses all that cash they generate. With billions in free cash flow, where do they prioritize putting it?
Management is very clear on this. The primary uses of capital are M&A and share buybacks. Notably, they don't currently pay a dividend.
No dividend. So it's all about reinvesting for growth or returning capital via buybacks.
Exactly. It reflects a focus on driving growth and total shareholder return through capital appreciation, not through income distribution. It's a reinvestment-heavy philosophy.
And have they been actively deploying capital according to these priorities?
Very actively. Take 2024 again, they deployed over $2.5 billion. It was roughly balanced. About $1.2 billion went to those acquisitions like Paymerang and GPS.
And the rest to buybacks.
And about $1.3 billion went to repurchasing shares. This shows they're flexible and opportunistic, shifting capital between external growth, M&A, and internal value enhancement, buybacks, based on where they see the best return at the time.
And with $1.5 billion in FCF projected for 2025, they've got plenty of capacity to keep doing both.
Significant capacity. This tells you clearly where their priorities lie. Funding growth and returning value through buybacks. And those share repurchases aren't just an afterthought. They are a consistent, significant part of the capital return strategy for Corpay.
So they're regularly in the market buying back their own stock.
Yes, especially when they feel the share price is dislocated or undervalued relative to their prospects, they see it as an efficient way to return capital.
And the goal is to reduce the number of outstanding shares, which boosts earnings per share, right?
That's a major benefit, yes. It directly drives EPS growth by shrinking the share count. They bought back $1.4 billion in 2022, nearly $700 million in 2023, and another $1.3 billion in 2024.
Wow, that's substantial and consistent activity.
It really is. It demonstrates a clear commitment to enhancing shareholder value through this mechanism. It's an important way for you to understand how cash-rich companies can boost returns even without a dividend.
We touched on their use of debt earlier. They clearly use it to fuel M&A and growth. How do they manage that debt load, especially in a tricky interest rate environment?
They explicitly use debt as part of optimizing their capital structure, keeping leverage within a defined target range to support those strategic initiatives.
And they've stayed within that range.
Yes. Leverage was 2.75x at the end of 24, down to 2.53x by mid-25, right within their target zone. They actively manage their debt portfolio.
What about managing the risk, particularly interest rate risk on floating rate debt, which has been a big issue lately?
That's where their financial sophistication comes in. They use tools like interest rate swaps to convert some floating rate debt to fixed rate, reducing their exposure to rate hikes.
Yeah.
They also use cross-currency swaps to manage FX risk associated with debt.
So they're proactively hedging those risks.
Yes, it provides greater predictability in their interest expense and protects them somewhat from volatility. It shows you a company that's sophisticated in its financial management, using debt strategically, but also actively mitigating the associated risks. All right, let's talk about the people driving this ship. Leadership quality and vision are absolutely critical, especially during a major pivot like Corpay's undertaking.
And at the top, you have a very long-tenured CEO, right? Ron Clark.
Extremely long-tenured. He's been CEO since the year 2000, chairman since 2003. That's nearly a quarter century at the helm.
Wow, that's incredibly rare these days. What's his track record?
He's widely credited with transforming the company from basically a regional fleet card player into the global S&P 500 B2B payments powerhouse it is today. His tenure provides immense institutional knowledge and strategic consistency.
So he's been the architect of this growth, focusing on M&A, efficiency.
Absolutely. A relentless focus on growth through disciplined M&A, operational efficiency, and now this clear vision to pivot towards corporate payments.
That stability at the top must be valuable. But you mentioned some recent changes lower down.
Yes, the executive team has seen some evolution. The CFO, Tom Panther, who oversaw the rebranding and recent deals, departed in March 2025. Peter Walker took over.
And changes in sales leadership, too.
Right. They created that unified U.S. Chief Revenue Officer role in 2024 to drive cross-selling. So while Clark provides the long-term vision, the effectiveness of this broader team, especially in executing these complex integrations, is really key right now.
So for you, appreciate the stability and vision from the top, but recognize the importance of that execution capability across the whole team during this intense period. And beyond the CEO, how does Corpay handle its overall corporate governance and communication with investors? Is it pretty transparent?
They actually stand out for their level of transparency, particularly in their financial guidance.
How so? What do they provide?
In their quarterly earnings releases and calls, they give remarkably detailed guidance, not just for the next quarter, but for the full fiscal year. And it's not just a headline number.
They break down the assumptions behind it.
Exactly. They provide specific assumptions for key macro variables that directly impact them. Things like U.S. fuel prices, those fuel spreads we talked about, FX rates, interest expense.
That level of detail must be really helpful for analysts and investors trying to model the business.
Incredibly valuable. It lets you understand the moving parts, the drivers of performance, and how management themselves sees the headwinds and tailwinds playing out. It reduces guesswork.
So even if we don't have specific insider ownership data handy, this commitment to detailed, transparent communication builds trust.
It does. For you, it means a clearer understanding of their perspective on the business and its trajectory. Okay, let's get to the bottom line, so to speak. Valuation. How do you value a company like Corpay that's kind of two things at once? Mature legacy business plus high-growth fintech.
Yeah, that hybrid model makes direct comparisons tricky, doesn't it? You can't just lump it in with pure-play software companies or old-school financial services.
Exactly. It requires a nuanced approach using multiple frameworks. Looking at traditional multiples, their trailing PE ratio is maybe 21-22x, kind of middle of its historical range.
But the forward PE is lower.
Right. Based on 2025 earnings estimates, it drops to around 14-15x. That reflects the market's expectation of continued earnings growth.
And what about growth-adjusted metrics, like the PEG ratio?
The PEG ratio is roughly around 1.0, which many consider signifies fair value. The PE ratio is roughly in line with the expected growth rate, so traditional metrics suggest it's priced for solid, but perhaps not explosive growth. Now, benchmarking against peers really highlights that hybrid challenge. It's a mixed bag.
How does it stack up against WEX, its main competitor in vehicle payments?
Compared to WEX, Corpay often trades at a similar PE multiple. But importantly, Corpay boasts significantly higher net profit margins, think mid-20s versus low teens for WEX. And some analysts give Corpay a stronger growth grade, so on a quality and growth-adjusted basis within that segment, Corpay might look more attractive.
But then compare it to the high-growth corporate payments fintechs.
And the story flips. Those pure-play AP automation or spend management companies, like Bill.com or Coupa, historically trade at much richer multiples, often high price-to-sales ratios.
Because of their SaaS models and higher growth?
Exactly. Corpay trades at a substantial discount to those peers. The market clearly isn't giving it the same multiple, likely due to the drag from the mature vehicle payments segment. It's still partly valued as the old FleetCor, #tag the sum of the parts approach. Which brings us to why sum of the parts analysis, or SOTP, is particularly relevant for Corpay.
Okay, explain SOTP. You value each piece separately.
Precisely. You try to assign an appropriate valuation multiple to each distinct business segment based on its specific growth profile and profitability, rather than using one blended multiple for the whole company.
So you give the mature vehicle segment a lower multiple, maybe based on industrial or traditional financial comps.
Right, and maybe an even lower one for the struggling lodging segment. But then you assign a much higher multiple, more like those fintech peers, to the fast-growing corporate payments segment.
And then add them all up to see what the total implied value is.
Exactly. An SOTP analysis could potentially reveal that the market is undervaluing the company because it's not fully appreciating the growing weight and higher intrinsic value of that corporate payments piece.
So for you, this approach might uncover hidden value if the market is overly focused on the legacy business and missing the transformation underway. All right, let's wrap this up by bringing the risks back into focus. We've touched on them throughout, but let's summarize the key potential roadblocks that could derail Corpay's strategy.
Absolutely crucial to keep these in mind. Broadly, you can group them into business operational, financial macro, and regulatory legal risks.
Okay, start with business operational. Competition.
Intense competition, yes. From WEX on one side and that whole fragmented universe of fintechs and banks on the corporate payment side, they need to execute flawlessly.
And the M&A integration risk we keep mentioning.
That's a huge operational risk right now. Successfully integrating Panorang, GPS, and especially the massive Alpha Group deal is critical. Failure could mean operational chaos, delayed synergies, write-downs.
Plus technology and cybersecurity risks. Always a concern for payments companies.
Always. System failures, data breaches, a major incident could be devastating financially and reputationally. They handle sensitive data and critical transactions.
Okay, what about financial and macroeconomic risks?
Sensitivity to economic downturns is key. Reduced corporate spending hits their volumes. We discussed fuel price volatility, foreign exchange risk impacting international earnings, and interest rate risk increasing borrowing costs.
Yeah.
These are ongoing pressures. And finally, regulatory and legal. The ongoing FTC litigation over fee practices is a clear overhang, potential fines, reputational damage. Plus, the global payments regulatory landscape is just incredibly complex and constantly changing data privacy rules like GDPR, anti-money laundering, AML requirements, interchange fee regulations. Compliance is costly and mistakes can be painful.
So a wide range of challenges. These are the major hurdles you need to weigh against the growth opportunities when evaluating Corpay's future. #tag outro. Wow, what a deep dive that was into Corpay Inc. We've really covered a lot of ground today.
I certainly have.
We've seen this company making a very deliberate strategic pivot, moving aggressively from its legacy in vehicle payments
Towards becoming this potential powerhouse in the much larger, faster-growing corporate payment space.
navigating macro headwinds,
Yeah.
executing a really ambitious M&A strategy. It's a complex story.
It is, but what really stands out to me is how a company with such inherent strengths, that operational efficiency, those high margins, that incredible cash flow,
Yeah, the financial engine is impressive.
is using that strength to fundamentally reshape its identity for future growth. It's a transformation driven from a position of strength, which is fascinating to watch.
So as we leave our listeners today, here's a final thought to chew on. What do you think is the single most critical factor for Corpay's future success?
Is it nailing the integration of those huge acquisitions, proving that M&A machine can handle this scale without stumbling?
Or maybe it's the market finally recognizing the shift, re-rating the stock to reflect that valuable corporate payments segment, escaping the shadow of the legacy business.
Or perhaps will those macroeconomic sensitivities and the constant regulatory pressures always act as a kind of governor on its potential, no matter how well they execute the strategy?
It really is a fascinating balancing act, isn't it? Playing out right now in the incredibly dynamic world of B2B payments. Definitely one to keep an eye on.
Couldn't agree more.
Thanks for joining us for this deep dive. We'll catch you next time.